Okay, everybody, welcome to Investing with IBD for November 6, 2019. I'm your host, Arusha Pierce, and with me today is Tom Dorsey, founder of Dorsey Wright, a legend in technical analysis, and an evangelist of point-and-figure charts. Thanks for being here, Tom.
It's my pleasure.
On today's podcast, we are going to talk about the current markets, the importance of relative strength, and we will go over a few current ideas. So let's get into the current market. Right now, we are in an uptrend. We have 3 distribution days on the S&P 500 and the Nasdaq. The major indices are at new highs, and more stocks are starting to hit new highs too. So the market is starting to get better. Tom, what are your thoughts? Because you are looking at the market in a little bit different way, and your indicators are looking pretty good these days too.
Well, if you picked up a newspaper and you listen to the news, you'd probably be thinking that the recession is right around the corner and it's all over.
Right.
And that's not the case. When I look at what I like is soulless barometers. In other words, I don't need to read verbiage on anything. I look at the chart, like the New York Stock Exchange bullish percent. That's probably the most important market indicator for me. And that's simply a calculation of the percentage of stocks on the New York Stock Exchange that are on point and figure buy signals. That's all.
Yep.
You could have a fourth grader do it. And when you've been in this business as long as I have, 45 years, you remember things. And this new buy signal that this chart just gave reminds me of August of 1982.
Wow.
Now, you might say I'm crazy, but August of 1982, I think that might be before you were born.
No, unfortunately not. I wish it was, but
no. Okay, you look very young.
Thank you.
But August of 1982 was the beginning of a 20-year bull market.
Right.
And if you read the newspapers today, all you hear about is recession, and everyone's got an agenda. This bullish percent index suggests to me that you've got the offensive team on the field, you have the football, you need to run plays.
And it's almost
when that changes, we'll change.
Yeah, and that's, you're listening to the market, you're going with your indicators, and you're just following the trend. Now, it's almost perfect that you're starting to get these indicators, and the sentiment is still very negative. That's the wall of worry that gives the power to strong bull markets.
That's exactly right. The market loves to climb a wall of worry, and can you think of any more worry out there?
Yeah.
It's almost beautiful. It's a symphony of worry.
Yes.
And everyone's sitting back saying, "Oh, the market's at new highs. We gotta pull back here." Well, I'll tell you what. In 1982, that was the beginning of a 20-year bull market, and that breakout that we had in 1982 was probably a 10 standard deviation breakout.
Wow.
And this kind of reminds me of it. So I don't see any problems. If this changes, I'll change.
Right. That's beautiful. Now you had some interesting. Let's talk about 2008 because you mentioned standard deviations.
Yep.
Let's talk about the S&P 500 yearly returns and how 2008 did on a standard deviation basis.
I came across accidentally a normal distribution of the Standard & Poor's 500 going back 100 years. And it was so interesting to me. All of a sudden, what caught my eye was 2008. And I asked anybody, I said, where do you think 2008 resided on that normal distribution or bell curve? And it was right down 3 standard deviations below trend, right next to 1937.
Wow.
And that's why people haven't forgotten 2008. It's still in their mind, firmly in their mind. And when you look at that normal distribution, you say, that's exactly why.
Right.
You could ask someone, 1987 was a terrible year. Well, it wasn't. The market ended up closing up on the year, not down, although we lost the equivalent of 6,000 points in one day.
Right.
You can imagine what would the media do if we lost 6,000 points today.
Right.
But if you woke up Rip Van Winkle at the end of 1987, he'd say the market was up marginally.
Yes, exactly.
So 2008 is what resonates with people.
Yep. Yeah, it was so people still think about it. People are always fearful. They're waiting for that next crash, right? And especially when the market's in new highs, they're like, "Oh, that crash is around the bend," and the media also feeds off of that too.
Oh, of course. Well, the media. What can you say about the media? They've made everyone in America dyslexic, and you can't believe what you read. Period.
Yeah. Yeah, and that's
So
why
you have to find a soulless barometer to look at and to understand and guide you. You can't listen to verbiage. That'll take you down the wrong path. Everyone's got an agenda.
now let's talk about 1973 to 74.
Okay?
Talk about that market and how challenging that market was.
Well, 1973 to 74 was a market that was a bear market. The blood came out drip by drip. It wasn't like the juggler was cut in 1987 and it was over in one day.
Yeah.
It came out drip by drip.
Yeah.
And the firms on Wall Street continued to say, we've hit a bottom, get your customers back in. And you get your customers back in, and it wasn't the bottom. And then they said, we hit a bottom, get them back in. They continued to do that until finally they said, put them on margin. We're at the bottom. And that wasn't the bottom.
Yeah.
And that's when I came in at Merrill Lynch prospecting these very people who had just been wiped out. So it was a terrible time, a protracted bear market. And back there in 74.
And so let's go. That's a good segue into your background, because you started at Merrill Lynch. How did you transition to point and figure? How did that whole process work and getting on that path?
Well, that's an interesting story because I'm not sure you want the length of the story, but it's after the first year of prospecting, I had people tell me to go to hell. And that was because I was prospecting people that had just been wiped out through 73, 74, but I had no idea. I was trained by Merrill Lynch to come sell.
Yeah.
And I'm a 20-something kid. I'm riding into town on a white horse. I'm going to save you.
Yeah.
Well, they didn't want to be saved.
Yeah.
So at the end of the first year, I said, if I'm going to be successful in this business, I better become an expert at something. And I chose options. Options then led me to ultimately running the option strategy department at Wheat First Securities. And the first person I hired brought in a book that was entitled The 3-Point Reversal Method of Point and Figure Stock Market Trading. And he said, I'd like you to read this so you'll understand the operating system in my mind. When I come to you with a stock or the sector or the market, you'll know how I think. So I took it to Virginia Beach that weekend. I read the first paragraph of the introduction, and my life profoundly changed. It was the epiphany. And I'll tell you why. I just recently came to understand exactly why. You see, I am dyslexic. Very hard for me to read all my life.
Yeah. And
all of a sudden I come across a chart that speaks to me. Nobody wrote anything on it. I didn't have to read it. And when I saw that, I said, I'm home free. This is going to be what I make for the rest of my life. And that happened that night, and that's exactly what I've done since then.
And from that, you started Dorsey Wright. You started using
Yes.
point and figure and got clients that way. And
right.
You were faxing your reports to your clients at that point on a fax machine you didn't even own.
No, because fax machines back then cost $1,800. We were using a Tandy 3000. I mean, that's in the Smithsonian Institute now. It doesn't run anything. And a fax machine did one paper at a time, $1,800. So we borrowed it from downstairs. They charge us, for each piece of paper. I would write the report every day and then go down and fax it to all 5 of our customers. And it would take me till 12 o'clock, lunchtime.
Wow. Yeah.
And that's how we did it. Then technology started to get better and better and better, and eventually it had automatic faxes. But that's what we used back then. And we used to update 2,500 charts by hand every day.
That's incredible.
2,500 point and figure charts by hand.
And how long?
Five analysts did 500.
Okay.
500 a day.
Okay, that's incredible. But then once technology came around, once computers came around, that did a lot of that work for you, and you were able to explore point and figure a lot more.
It did all the work for us.
Yeah.
But I still had to pry the books out of their hands. They didn't want to give it up.
Right, because they were starting to develop such a feel for the market and those stocks, right? Just by doing it day by day, marking those charts up.
And seeing the charts.
Yeah.
That's right. And that's how you become world class.
Yeah, that makes absolute sense. You're getting down to the nitty-gritty.
So the interesting thing is back then, while you're updating those charts, you're seeing potential ideas, and they would write them down. Today, with technology, all you have to do is go to the computer and say, give me a list of the stocks that have pulled back 10%, are within 10% of their trend line, are this and that, give me the list.
Yeah.
Back then, you had to look at it and write the list down.
Right.
Now you just tell the computer, give me the list.
Right. So you got the ideas earlier, but you might not have the feel for the market.
Oh yeah,
Right.
that's gone.
So now you had another really interesting point when we were talking yesterday about 2008, what the stocks that the sectors that were coming up at that point versus now, right? And this is another reason why you are bullish on the market. What were the top sectors in 2008, or top asset classes, really?
Well, the way we look at it is called the dynamic asset level investment. We call it DALI. And what we do is we take 6 asset classes and we put them through a relative strength calculation to determine which asset classes are the strongest. And that's a pretty stringent course going through that relative strength. Back in 2000, and then what we did in 2008, the top 2 asset classes would become 100% of your portfolio.
Okay.
The interesting that happened in 2008, through no brilliance of our own, just doing the relative strength calculation, is all through 2008, no equities showed up in space 1 and 2.
Wow.
U.S. equities and international equities were in 5 and 6, and you couldn't even get down that low to put them into any portfolios. Today, I sit back and I say, well, if things are going to get really bad here, we'll probably end up looking like 2008, at least in the beginning of 2008. That's not the case. The case is U.S. equities are ranked number 1, international equities ranked number 2, which is the exact opposite of 2008.
Right. So if you listen to the market right now, you are bullish. The indices are at new highs. Underneath the surface, stocks are setting up. So let's take a quick break. But when we return, we're going to talk about the importance of relative strength, and really that's some of the power behind that help those asset classes rise to the top and give Tom that indication of which ones to look at. Stay tuned. Hey, Arusha here with a big announcement. We have launched a brand new interactive video broadcast called IBD Live. IBD Live takes you behind the curtain to see how professionals trade. Log on and watch live as IBD's analysts and portfolio managers follow the first hour of market action and pick winning stocks. You get to listen to our conversations, see our screens, and ask us questions all in real time. If you've ever wanted to trade alongside a team of experts, this is your chance. Go to investors.com/IBD Live and sign up to get your first 2 weeks for free. Tom Dorsey is our guest on Investing with IBD. Okay, Tom, let's talk about the importance of relative strength and why it is essential for your strategy.
Well, relative strength is a much more longer-term picture than a trend chart. And in the things that we've created with exchange-traded funds and modeling, we want to be more longer-term in nature. But it's interesting to compare and contrast. Let's say, and here's an example. Let's compare and contrast Coca-Cola and Pepsi. I would ask you if you could you pass the Pepsi challenge?
Probably not.
Put them in front of you, blindfold you, and tell me which one is which. But if that's all you were allowed to invest in your whole life,
right, is
Coke or Pepsi, you'd go to Morgan Stanley and you'd say, hey, could I get a report on Coca-Cola? You'd have a nice thick report by a PhD, 3-piece suit guy from Harvard, and probably an inch thick, greatest company, greatest brand. Then you say, okay, let me go get a fundamental report on Pepsi-Cola. I'll go to Goldman Sachs. Same thing, inch thick. This guy's from Yale, 3-piece suit, PhD. You look at the two of them, you say, wow, these are beautiful companies, fundamentally sound, but I can only buy one of them.
Right.
Which one?
Right.
Now what I got to do is I got to bring them to an arm wrestling contest. I need to see which one is the strongest. And we do that by simple 4th grade division. And I tell people, I said, if you've got any children in the 4th grade or nieces and nephews, they can help you with this. It's just to divide one thing by another. So let's just make a movie here and say Coca-Cola is $100 and Pepsi's $50. I divide Coke by Pepsi. I get 2. I'm going to add a 0 just to make it easier to chart. So now I've got a number that's like a trend chart, but it's not. It's the relative movement between the two. So by dividing those two, I get a number. I plot that on a point and figure chart, which is the basic X's and O's, simplicity, simplicity, simplicity. And then we watch these stocks, or we watch sectors. So let's say that on Coca-Cola and Pepsi, all of a sudden the shackles were taken off you, and they said you can buy any stock in the beverage sector. Oh, wow, this is cool. Now there's 70 stocks in the beverage sector. What do we do now?
Yeah.
Well, we do that same calculation 70 times. 7 times 7, 49. We do 4,900 charts. Can't do it by hand.
Right.
But we do 4,900 charts to determine which one is the strongest, which one is the weakest. And every time I look at that, I just say to myself, it's like a miracle. Because you know what we do? 30 years ago, we used to be able to do 200 per week. Tammy typically did it, 200 per week by hand. You know how many we do a night now?
No.
14 million.
Oh, my God. So
14 million. And it's not AI. It's just intelligence.
Yeah.
Not artificial.
Now, were you the first company to divide and do the relative strength on a point and figure chart?
Absolutely not. The first company to do that was Chartcraft.
Okay.
Chartcraft were the purveyors, the biggest purveyors of point and figure charts back. Oh boy, they go back probably into the 50s.
Okay.
You know, it could be even the 40s, and there were companies in the 40s. Yeah, that's just basic arithmetic. I think we're the ones that brought that concept to the mainstream, the main line. And if you're doing relative strength, you're going to find it with us.
Right. And so you combine the relative strength with the point and figure, you put it against the whole market, all the sectors, and that's going to continue to lead you in the right direction.
Yes, absolutely. We believe that.
And you have you have the proof over 30 plus years too, right? 2008.
Yeah.
It told you not to be in equities. It got you back in.
We're still here. Yeah. Well, I mean, the interesting thing about that is that, you know, back in the day when I was a broker and somebody came into the office and said, "Where's the technician?" They'd say, "Hey, he's over there in the corner. I mean, he's got that strange tick about him. Don't talk to him too much. You know, leave him alone." Fundamental guys were up in the front of the class. Well, 30 years later, Nasdaq finds it necessary to buy a technical analysis company. We move to the front of the class, plain and simple. I don't care what anybody says. We're no longer that guy in the back. Don't talk to him.
Yeah.
We're up front.
Yeah. And technology in the end kind of showed the power of that system, because it didn't require only a few analysts who could go only over so many charts. Now you could do 14 million charts and really just keep moving into those stocks that have, or stocks or instruments that have that potential.
Yeah, we compare everything. Now you can just let the computer. You should be able to run $1 billion portfolio from a cruise ship with an iPhone. Plain and simple. I would suggest everybody get the 4-Hour Work Week book.
Yep.
Not 4 day.
Yeah.
4 hour.
By Tim Ferriss.
By Tim Ferriss. And because the technology is here for us to be able to do those things, like our system on at Dorsey Wright system can do anything in the world. You just have to learn how to key it in and say, "Give it to me." Whenever I see it, whenever I'm interested in the stock, first thing I do is I go over and I click an alert. I say, I want to see if that goes into a column of O's. I want to see if it gives a buy signal. I want to see if this happens. I've got any number of 40 different things I can do that I'll get emailed.
Yeah.
So I don't have to go back and look at the chart and follow it and stay and keep the system will let me know. All of a sudden one morning I get an email and says, "Hey, remember Minnesota mining that you were interested in a long time ago?" "Nah, I can't remember. What was it?" And click it. "Oh, wow. Here it is. This is what I was looking for."
Yeah. Now
that's the beauty of it.
Yeah, because it's a system. Now let's talk about the benefits of having a system like that. It removes the emotion out of investing. Talk about just kind of the dangers of emotion and investing.
Oh yeah, the dangers of emotion. I mean, that's a killer. People get emotional, and I think what was the study where people fear a decline in a stock more than they enjoy an up move.
Yep.
As soon as the stock starts wiggling the wrong way, they want to get out. You have to. I don't have any problem with getting out of a stock or making a change or whatnot, but let the soulless barometer suggest it to you. Let it give a sell signal. Let the trend line break. A lot of times stocks will pull back, and that's just the pause that refreshes.
Yeah, and so now you're using the system. You're able to manage a number of different portfolios, including one that's based in Indonesian stocks too, right?
Yes, interesting you bring that up. I have run a model in Indonesia at esamuel.com in Jakarta, Indonesia. And this is a model that we run. It's a relative strength model.
Yeah.
So we take the most liquid stocks they have, put them into the relative strength mixer, and we calculate the strongest to the weakest. I simply buy the top 5 strongest and wait for the system to say, you know what? Hey, this particular stock has walked too many batters. It hit a couple of guys. I got to take him off and bring somebody in and change it. I let the system do it. So I've run this model for 14 years now in Indonesia. I can't even pronounce the names of the stocks.
But you're just following the charts.
I have no idea what the names of I can't pronounce them. But they're the right guys on my ball team.
Yeah.
And I just let it run. So here's what happens. The system then gives me an email and says, excuse me, that so-and-so stock has come out of the portfolio. We've replaced it with this one. And what I do is I click forward. I type Y. The system automatically knows that's Juliana. She's my broker there. And I say, please make the changes. I'm on a cruise ship, man, saying, okay, which restaurant are we going to go to? I'm managing a portfolio in Indonesia, can't pronounce the names, and my system is watching it for me.
Yeah.
We have 80 different models that do that.
Wow. Well, and that's all just the benefit of relative strength charts, just leading you in,
absolutely.
Right?
Benefit of technology, being able to do it fast, compare and contrast. So what I do every day is I have clicked every one of our models, and I said, any changes I want to know. So I get a lot of changes in models. 90% of the changes I'm not going to be involved in, but I want to see it.
Yeah.
So if there was a change in the utility model, I'm probably going to click it on and see what utility came in, what utility came out.
Okay, and then you're going to pull up the chart there and take a look. Okay, it's the point and figure chart.
I may or may not.
Okay.
I might be going to lunch.
and just let and see if anything else changes the next day, right?
Well, not the next day, because these changes, point and figure, a relative strength chart typically can last 2 to 2.5 years.
Okay.
So they don't change rapidly. They're very slow to change. And we also give them wiggle room, because you couldn't, if you had a model, every time that stock dropped a little bit and you took it out of the portfolio, you'd be trading the portfolio. So you have to give it it's just like a baseball game. You let that pitcher that starts the game out walk a certain number of people, got a few home runs, and then finally in the 4th inning, the coach goes out and says, hey, Jim, it's not your day.
Yep.
And another pitcher comes in from the bullpen, he goes into the dugout. That's exactly the way it works. No difference.
Yeah, so you're writing just a primary trend for all of these instruments that you're investing in.
That's right. And I also run our international developed markets models at Diff Brokerage in Portugal. I own a small piece of that company, but the traders just run those models, and they're hooked up to our system. Yeah. So the only thing I get from the trader is, just made a trade in Sweden. Okay, I know why. We had to take that picture out and put another one in.
Yeah, that's beautiful.
So that's where the 4-hour work week comes in.
Yeah.
Why work so hard? Let the system manage it. Let technology run it for you.
Yeah, and let the market tell you what to do in the end.
That's exactly right. Exactly right.
So relative strength is everything, and having a system is incredibly important. And it helps you focus on the best stocks. It really helps you focus on, it doesn't matter what instrument you're using, it helps you focus on the best ones. Thanks so much, Tom, for joining us today.
My pleasure, anytime.
That's it for this week on Investing with IBD. Next week, we are going to have Duncan Rolfe on the show. Duncan is the managing director of Miracle Mile Advisors. He advises high net worth families on portfolio construction and investment policy development. So that's it. I'm Arusha Pierce, and thanks for listening. And for this week's Notes and Charts, make sure to go to investors.com/podcast, where you'll find details for each episode in the podcast episode section. And make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it. You can also send us your questions and comments to investingpodcast@investors.com. We would love to hear from you and may use your comments on an upcoming episode.